Welcome to the third video on Leasing IFRS 16. We're now looking at those leases which are exempt from this standard. So a lessee can elect to leave the following leases off balance sheet. The first one is short-term leases. Short-term leases are leases with a lease term of 12 months or less. This selection is made on a class by class of underlying asset. If a lease contains a purchase option, it cannot be a short-term lease. The second one are low-value leases. These are leases where the underlying asset has a low value when new, such as tablets, personal computers, or small items of office furniture and telephones. This selection also can be made on a lease-by-lease basis. An underlying asset qualifies as low value only if two conditions apply. The first one being the lessee can benefit from using the underlying asset. The second one, the underlying asset is not highly dependent on or highly interrelated with other assets. The accounting treatment of such leases is that the lease payments are recognized as an expense in the profit and loss on a straight line basis over the lease term, unless some other systematic basis is representative of the time pattern of the user's benefits. We look at an example. Oscar Co. is preparing its financial statement for the year ended 31st June X3 on 1st May 30 June X6. On 1st May X6, Oscar made a payment of 32,000 for an 8-month lease of a milling machine. Required what amount should be charged to Oscar's statement of profit or loss for the year ended 30th June X6 in respect of this transaction. The lease is for 8 months. So this counts as a short-term lease since it's less than 12 months, and so it does not need to be recognized in the statement of financial position. The amount charged to P&L for the year ended 30th June X6 is therefore 32,000 divided by 8 months, but we only need 2 months because we acquired this milling machine on 1st May and our year end is 30th June, so May and June, so times 2 months to give us 8,000 as our charge to the P&L. We move to the last segment of this standard, which is a sale and leaseback transactions. A sale and leaseback transaction involves the sale of an asset and the leasing back of the same asset. The key question in determining the accounting treatment is, does the transaction constitute a sale? For a transaction to constitute a sale, this is determined by considering when the performance obligation is satisfied in accordance with IFRS 15 revenues from contract with customers. So if you have not yet done revenues, you need to do revenues. So we borrow from IFRS 15 revenues from contracts in determining whether a transaction constitutes a sale. So the accounting treatment is as follows. If the transaction is a sale as per IFRS IFRS 15, measure the right of use asset arising from the leaseback at the proportion of the previous carrying amount of the asset that relates to the right of use retained by the seller or lessee. This is calculated as carrying amount times discounted lease payments over the fair value. The discounted lease payments are calculated as for any other lease. So you recognize only the amount of any gain or loss on the sale that relates to the rights transferred to the buyer or the lessor. To do this, you calculate this in 3 stages. Step 1 is first to calculate the gain, which is calculated as fair value, which is usually the proceeds less the carrying amount. Then step 2 is to calculate the gain that relates to rights retained, which is calculated as follows: gain times discounted lease payments over the fair value equals the gain relating to rights retained. Then stage 3, the gain relating to rights transferred is the balancing figure. So gain on rights transferred is equal to total gain from stage 1 less gain on rights retained in stage 2. The right of use asset continues to be depreciated as normal, although a revision of its remaining useful life may be necessary to restrict it to the lease term. We look at an example. On 1st January 2006, ESCO sold its head office building to ECO for $3 million and immediately leased it back on a 10-year lease. On that date, the carrying value of the building was $2.6 million and its fair value was $3 million. The present value of the lease payment was calculated as $2.1 million. The remaining useful life of the building at 1st January X6 was 15 years. The transaction constituted a sale in accordance with IFRS 15, so we don't need to do the test there. Required: a right of use asset must be recognized in respect of the leased building. At what value should the right of use asset be recognized on 1st January X6 in the financial statement of ESCO? Requirement 2, what is the gain on the sale that may be recognized at 1st January X6 in the financial statement of ESCO? IFRS 16 requires that at the start of the lease, S should measure the right of use asset arising from the leaseback of the building at the proportion of the previous carrying amount of the asset of the building that relates to the right of use retained. This is calculated as carrying amount times discounted lease payments over the fair value. The discounted lease payments were given in the question as 2.1. The carrying amount were given the carrying amount there as 2.6 million. So 2.6 million times 2.1 divided by the 3 million, which is the fair value. That gives us 1,820,000 as the value of the right of use asset to recognize on 1st January X6. We move to compute the gain. S should recognize the amount of gain that relates to the rights transferred, which we learned we do this in 3 stages. The first stage is to calculate the gain by subtracting the carrying amount from the sales proceeds, or the fair value. The fair value in this case, which is 3 million, the carrying amount, which is 2.6, so 3 million minus 2.6 gives us a gain of 400,000. Then we move to step 2. Step 2 is calculate gain that relates to the rights retained, which is given by the formula gain times discounted lease payments over fair value. The gain we've just computed as 400,000. The discounted lease payments, we are given as a present value of 2.1 divided by the fair value of 3 million. Which gives us 280,000 as the gain relating to rights retained. That we take into step 3. Step 3 is gain relating to rights transferred, is the balancing figure, which is computed by total gain from stage 1, the 400,000, less the gains in stage 2, the 280,000. So 400,000 minus 280,000 gives us the gains relating to rights transferred. We move to the last segment of our study. Other points to take into consideration: if the fair value of the proceed does not equal the fair value of the asset sold, adjustments need to be made. The first one, if sales proceeds is less than the fair value, you treat the shortfall as a prepayment of lease payments. The shortfall in consideration received from the lessor is treated as a lease payment made by the lessee. The second one is if sales proceeds is greater than fair value, you treat the excess over fair value as additional financing, i.e. as a liability, not a gain on the sale. And finally, if the transaction is not a sale as per IFRS16, if the transfer does not satisfy the IFRS 15 requirements to be accounted for as a sale, the seller must continue to recognize the transferred asset. Then it is not a sale. The transfer proceeds are treated as a financial liability accounted for in accordance with IFRS 9 financial instruments, it means the transaction is more of in the nature of a secured loan. So that concludes our study on leasing IFRS 16. You do well to practice some questions now in the ref kit. Make reference to our study. Thank you, and we'll catch you in the next video.